I'm Charlotte McLeod with the Investing News Network, and here with me today is Jonathan Guy, Director of Metals and Mining Research at Numis Securities. Thanks so much for being here.
Thank you.
So we're here at the Precious Metals Summit right now. What's your sense of the sentiment here right now?
Well, look, notwithstanding the gold price has pulled back above 1,500 over recent days, I would say that the sentiment here is overwhelmingly positive. We saw a major technical breakout in the precious metal over the summer. That's seen it move back to a sort of multi-year high, and I think really sort of embeds the recovery both in the metal price and in the price of equities after the major sell-off that we saw in 2013. So pretty positive. Obviously there are questions about how that's going to feed through to the junior end of the market. And obviously, I guess people still want to see how the M&A at the larger end of the market cap space pans out, but overwhelmingly a positive sense of sentiment here this year.
Yeah, and you talked about the gold price run that we've seen in recent weeks and really this year as a whole. What's your take on the key drivers for that movement?
It's really down to US rate trajectory and concerns about trade. So if you look at Bloomberg, it rates the probability of a rate cut next week at 100%. And so the market has switched from a position earlier in the year when the expectation was for the Fed to perhaps continue to hike rates to one where not only is a cut's expected, but a fairly aggressive cut trajectory. And if the economy stumbles over, possibly even some sort of QE emerging again. That makes non-yielding assets like gold attractive and has inflated the gold price. So that's been really what's driven it to this level.
So more of that, then you hear some people talk also about the geopolitical things going on.
I think geopolitical shocks do have an impact on gold, but they're linked in. The ones that really move it are those that are linked into the economy. So the concern about a major US-China trade war, what that means for trade and what that ultimately means feeding back into rates again is, I think, the real driver. I don't think people are as concerned about North Korea or Iran or Saudi, Yemen or any of those other perhaps more security-related issues.
So for you, would you say that this is a real gold price move? We're going to stick here. What are your thoughts? Lots of people are asking that.
So, yes, I think it is real, and I think it has the potential to run on from here with gold perhaps increasing to maybe $1,600, $1,700 an ounce over the next 12 to 18 months, assuming you see a slowdown in the US, assuming you see a slowdown in Europe, and assuming you see, as the Chinese government expects, a slowdown in Chinese economic growth as well. All of those things point towards stimulus. All of those things should be beneficial for hard assets like gold.
What would you think that the trajectory for the rest of this year would look like? Are we going straight up? Will there be any setbacks or consolidation in there?
I think my main concern at the moment is around what this move means for the physical gold market. So the physical gold market is principally driven by India and China. Those markets are relatively price sensitive. So what we've seen in the past is when the gold price moves above around about 85,000 rupees per ounce, and when the gold price moves around above about 8,000 renminbi per ounce, then there is a significant and negative impact on demand. Now, gold is well above those levels at the moment. So to sustain gold at this level, you need to see continuous investor buying, principally through the mechanism of buying ETFs. If you look at the Swiss export data over the last couple of months, you've seen big outflows from Switzerland into the UK and the UK into the ETFs, and that's what's driving it at the moment. If you don't see those inflows, and if the price remains at above a level where Asian buyers will step in, and it's way above that level at the moment, then the gold price has to pull back. That's the major concern at the moment.
Yeah, that was going to be my next question. Is there anything that could throw gold off of the path that it's on? So that would be what we should look for.
Yeah, absolutely. It's look at in terms of the weekly data, the two things to look out for are what are the ETFs doing? Are we seeing week-on-week inflows into the ETFs? And are we seeing the net speculative position, which remains at near a record high level at the moment on COMEX? Both of those things continue to sort of flag positive or negative.
Okay, so obviously everybody's talking about the gold price right now, but are there any other themes that you're noticing in the gold market at the moment? Last year, this time, mergers and acquisitions was a big theme. What are you seeing right now?
M&A it continues to be a big theme. So the move we saw last year, and the two big mergers that people would obviously sort of have an opinion on would be Barrick and Randgold at the end of the year, and Newmont and Goldcorp. Now, First of all, people look at those companies and say they're going to shrink, they're going to get rid of non-core assets, and we expect to see some of those assets start to come back to the market over the next few months. I think beyond that, what people are saying is, well, what's the tier below that going to do? Do they continue to consolidate? What do they do with it? How aggressively do they pitch for those assets? Particularly looking at Australia. If you look at the average Australian gold equity at the moment, it's trading at about 2 to 2.5 times price to NAV, a significant premium to the rest of the global gold market. So these guys have premium paper. They have limited opportunities to consolidate internally within Australia, and so they need to start looking overseas. Now, we've seen them make some selective purchases. We saw Pogo being acquired by Northern Star. We've seen Newcrest go out and acquire assets in Canada as well. So what do the Australians do? How do they use that highly rated paper? What else do they go out and buy? I think so. I think M&A is going to continue to be a theme moving forward. And also, how do the juniors finance themselves? The top part of the gold market is working relatively well in terms of investors being in the space, investors wanting to be into the space. The part which remains inefficient are the very small producers and the pre-producers, because there are fewer people who are investing in gold mining equities after years of underperformance. A number of the funds that used to invest in them have pulled out of the space altogether or shut it up shop. And so where does that money come from? Does it come from corporates? Does it come from PE groups? I think those are the big questions that need answering at the moment.
Yeah, actually, I've been asking people, is there money in the space right now, and where is it coming from? So do you have any insight on the answers we might get?
Yes, there is money in the space,
yeah.
But the money in the space is not coming from where it would have come from 10 years ago. So 10 years ago, it would have come from Bay Street, it would have come from some of the fund managers in London or other major financing centres in Europe. Those people are still there, but there are fewer of them, and many of them have less under management than they would have had at the peak of the last cycle. So what steps in? And the two things that have stepped in are firstly PE groups, and they've been more aggressive with their term sheets than they have previously. They've gone out and they've looked at pre-producers and people who don't have cash flow, so that means they've had to look at equity as well as putting debt into structures. And the second big change is amongst the majors. The majors perhaps are less committed to their own exploration programs because the junior market is inefficient. It is cheaper for them to invest in the juniors and use that as their way to gain exposure. So what we've seen, if you go to these conferences, is most of these companies will have a major miner holding 10, 15, 20% of their stock, and that's the way that they will finance themselves. That's the big change from the last cycle.
Would you say that's a positive change?
I think it's neither positive nor negative. I think it perhaps just reflects, both of those things reflect, for me, a lack of discipline in the junior market in the last cycle. So people were raising money, they weren't necessarily spending it wisely, and investors got burned. So investors just want to make money and withdrew from the space. PE groups and mining companies are much more aggressive in terms of the way that they manage their investments. They won't let management teams put their lifestyles through the company in the same ways. They won't let people, waste money on projects that aren't going anywhere. So the sector, the junior part of the sector, has put itself in a position where it's having more discipline forced on it.
Right.
And so I suppose, that is a positive thing.
I think last question would be, what's the best way for investors to get involved in the gold space right now? Should they be looking at juniors? Should they be looking at stocks or physical metal?
I think there's always a role for physical metal in any portfolio, irrespective of whether you're trying to play a gold theme or a broader macro theme. It provides a degree of security. Gold holds holds its value over time. Over time, gold is money. So physical gold should be in everyone's portfolio, whether you hold 1%, whether you hold 10% of your portfolio in gold. I think there is definitely a role for it there. In terms of the rest of it, absolutely having some of the larger miners in there has been the right thing to do over the last year. They provided great exposure to a rising gold price environment and have offered real leverage to the space. And the juniors, they will run at some point, but you've got to be a real stock picker. You've got to know what you're doing in terms of the technical aspects of the business, if that's the place you're going to invest in, or you need to look at some of the gold funds, whether it be the JP Morgan fund, the BlackRock fund, or Fidelity, or others who are specialist investors in the space. The junior market can be a bit Wild West. If you don't really have a feel for it yourself, it's probably better to be paying a specialist to do it for you.
Going back to your previous comment about the juniors, would you say they're a safer investment now with some of that control pushed onto them than they were previously?
Possibly, but the reality with the juniors is it's a high-risk business. It's very much like biotech. You have a thesis that this project is going to work out, that you have a good handle on geology, that you have a good handle on the metallurgy, that you handle on how to interact with the government and local communities. All of those things may prove to be the case, and you can make 10 times your money. You're not going to make 10 times your money on Barrick Gold, but the risks are there as well. So they are maybe safer than they were, but it's still at the high risk of the investing spectrum.
Thank you so much. Once again, I'm Charlotte McLeod with the Investing News Network. This is Jonathan Guy with Numis Securities.